Hi everyone, my name is Proscovia. Welcome to the Accountant's Corner. This is the page where we discuss different matters related to the accounting profession, as well as different standards that are applicable in the preparation of general purpose financial statements. Today we're going to have a quick review of I-36, impairment of assets. This standard was adopted by the International Accounting Standards Board in April 2001, and the latest amendments were made to this standard in May 2013. Well, the objective of this standard is to prescribe the procedures that an entity can use to ensure that the carrying amount of an asset which is carried in the financial statements does not exceed its recoverable amount. Join me into this review up to the end. Thank you. Okay, now let's see the key definitions involved in this standard. An impairment loss is the amount by which the carrying amount of an asset or cash generating unit exceeds its recoverable amount. So when we say about impairment of an asset or impairment loss, equals to when the carrying amount is greater than the recoverable amount of an asset. So let us see on what the carrying amount and the recoverable amount refer to. Okay. An asset is defined as a resource controlled by the entity as a result of past events. Okay, the source which is currently controlled by the entity and it has resulted from the past events. For example, when the entity has purchased that asset or maybe produced it, and right now it is in control. And when we say about control, I mean that the entity has the power to receive the economic benefits or service potential which are embodied into that asset. And also, when we talk about control, I mean that the entity has the power to restrict others from the use of that asset. A cash generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. So when you talk about the cash generating units, we mean the group of assets in which each individual asset cannot generate cash inflows independently unless it is in that group. So a group as a whole generates cash inflows. Okay. Okay, now the carrying amount of an asset is the amount by which the asset is recognized in the financial statements after deducting the accumulated depreciation or amortization in case of intangible assets and the accumulated impairment losses thereon. So the carrying amount of an asset, we mean the carrying amount is earned by carrying amount of an asset equals to, we take about the original cost of an asset, we deduct any accumulated depreciation, and any accumulated impairments which were first recognized. Okay, so this is the amount which appears in the balance sheet of an asset. The balance sheet of the financial statement, whereby we take the asset amounts, deduct accumulated depreciation, deduct impairment loss, and that you get the carrying amount, the book value of the assets. And the recoverable amount of an asset or cash generating unit is the higher of the fair value of an asset, fair value less cost to sell, and its value in use. When you say about fair value less cost to sell, it's an amount which an entity can recover from the sale of an asset. And the value in use is the amount of which an entity can gain from using the asset. Okay, now let's see what does fair value less cost to sell mean. Fair value is the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants at a measurement date. So normally a fair value is an amount by which an entity is going to receive as a sale of an asset in an arm's length transaction and between knowledgeable and willing parties. So cost of disposal are incremental costs directly attributable to the disposal of an asset or cash generating unit after excluding finance costs and income tax expenses. So here we mean the costs that are directly attributable to the sale of an asset. So cost to sell may include cost of disposal, such as legal costs, stamp duty, and transaction taxes. Also may include cost of dismantling an asset to bring it ready to its sale condition. And here, there are costs that should not be included as cost to sell of an asset. For example, termination benefits. As a result of the sale of an asset, some workers may be terminated as they become idle. And so any termination benefits which have been incurred should not be included in the cost to sell an asset. And also, costs associated with reducing or reorganizing a business as a result of disposal of an asset also should not be included in the cost of disposal of an asset. Next, let's see what does value in use mean. So value in use is the present value of future cash inflows from using an asset, including the proceeds of sale of the scrap. So it is the present value of the future cash flows from using the asset and also from the proceeds of the sale of the scrap. Okay, and how do we find the value in use? First of all, we have to estimate the future cash inflows and outflows to be derived from the continuing use of the asset. For example, if you're going to use this asset, maybe you're going to generate sales of maybe 10,000. And as a result, there are expenses which have been incurred, let's say 3,000. So we include the inflows and we deduct the outflows. And thereafter, we also include any inflows from disposal of that asset at the end of its useful life. And after estimating these amounts, we are going to apply the discount rate to those future cash flows in order to find the present value. And the discount rate which we're going to use is the pre-tax discounting rate, and also we're going to use the pre-tax cash flows. Okay, now let's see what are the bases for estimating the future cash flows. First, the reasonable and supportable assumptions that represent the management-based estimate of a range of economic conditions that will exist over the remaining useful life of the asset. So here are the assumptions that are reasonable and supportable, established by the management, and also which reflect the economic condition that will exist for the remaining period useful life of the asset. And second, future cash flows can be estimated using the financial budget and forecasts which are approved by the management, excluding any future cash inflows and outflows expected to arise from restructuring or improving or enhancing the asset performance. Okay, now here are 3 things to note when estimating the future cash inflows for the purpose of finding the asset's value in use. First, we are going to include any cash flows from the continuing use of an asset. Let's say, for example, cash from sales. Second, we are going to exclude any cash outflows that are incurred necessary to generate the cash inflows which are mentioned in the first point there. And third, we are going to include any net cash flows which are to be received during the disposal of the asset at the end of its economic useful life. In estimating the future cash inflows, do not include any income tax receipts or payments, cash inflows or outflows from financing activities, and third, payment of future restructuring costs of which the entity is not submitted to. Payment of future restructuring costs for which the entity is not submitted to. Okay, so there's another point to note here, that when you're establishing the future cash flows, the estimate should be based in the asset's current condition. And therefore, if we expect that certain improvements will be made to the asset, which will result to increase in the cash inflows, those cash inflows which are subject to future improvements should not be included here, but the cash inflows which are based on the current condition. And therefore, any future restructuring costs which an entity is not committed to, and any improving or enhancement of the asset performance, which result to increase in future cash inflows, should not be considered here. As you mentioned earlier, the discounting rate which will be used to discount the future cash flows should be the pre-tax discounting rate, which reflect the current market assessment of the time value of money as well as risk specific to the asset. Okay, then there are points here to note when measuring the recoverable amount. For example, if it's not possible to measure the fair value less cost to sell, the entity may be advised to use the value in use as its recoverable amount. For example, when it's not possible to make a reliable estimate of the price at which an orderly transaction to sell the asset would take place between market participants at a measurement date and at the current market conditions. And also, if there is no reason to believe that the asset's value in use materially exceeds its fair value less cost of disposal, and the asset's fair value less cost of disposal may be used as recoverable amount. Mind you that the recoverable amount is the higher of value in use and fair value less cost to sell. Now let's see on when an entity is supposed to conduct an impairment test. So an entity is supposed to assess at each reporting period whether there are any indications for impairment. And if there are any indications that the asset might have been impaired, the entity is supposed to conduct an impairment test. And therefore, the impairment test will be conducted only when there are evidence that the asset may have been impaired. However, there is an exception here. An entity is supposed to conduct an impairment test annually to the below type of assets. First, the intangible assets with indefinite useful life. Second, intangible assets which is not yet available for use. And third, the goodwill acquired in business combination. So for these three types of assets, an entity is supposed to conduct impairment tests annually. Whereas in other kind of assets, the entity will perform impairment tests only when there are indications that the asset may have been impaired. Now here are the indicators of impairment, which are divided into external and internal sources. So external sources of impairment are as below. First, when there are observable indications that the asset market value has declined during the period, more than would have been expected as a result of passage of time. So when it happens that the market value of the asset has declined significantly, this also might imply that the assets may have impaired. Second, when there are significant changes with adverse effects on the entity, which have taken place or are expected to be taken place in the near future. For For example, technological changes, market economic changes, or legal environment that might affect the asset significantly. Third, the market interest rate, the market interest rate have increased during the period. So the market interest rate will affect the discount rate, which is used in estimating the value in use. So when there is a change in the market interest rate, also might imply that the possibility for impairment of an asset. And fourth, the carrying amount of the net assets of the entity is more than its marketed capitalization. So here are the external sources of impairment. Now let's go see the internal sources. So internal sources are those which can be found internally from the organization. First, when there is evidence about the obsolescence or physical damage of the asset, for example, if there was an accident and the asset has been damaged, so this may also imply the impairment of that asset. Second, there are significant changes within the entity which have taken place or might take place in the near future, which can affect the manner in which the asset is used or is expected to be used, the manner in which the asset is used or expected to be used. And these internal changes might be, for example, when the asset becomes idle, or maybe there are plans to discontinue or restructure the operation to which the asset belongs, or when there are plans to dispose an asset before the previously expected date, and the reassessing the useful life on the asset is finite rather than indefinite. Another source could be the evidence from internal reporting that indicates the economic performance of an asset is or will be worse than expected. That the internal reporting may indicate the asset may be impaired and due to the existence of the following. Cash flows for acquiring the asset or cash needs to operate or maintaining the asset have become higher than those originally budgeted. Also, the actual net cash flows or operating profit from the asset is significantly worse than those budgeted. Third is significant decline in the budgeted net cash flows or operating profit from the assets. There is significant increase in budgeted loss flowing from the assets. And fourth, operating loss or net cash outflows of the assets when current period amounts are aggregated with budget amounts for the future. Okay, now let's see how the impairment loss is recognized in the financial statements. Impairment loss of an invalid asset will be taken to the profit or loss account. Whereas if whereas the impairment of a previously valued asset, for example, the asset is being carried using a valuation model, and there was the valuation gain which was previously recognized the comprehensive income. That means the impairment loss which has occurred right now will first be netted off with the valuation gain, and if there is any balance of that impairment loss, will then be taken to the profit or loss account. Okay, and after the recognition of impairment loss, the depreciation or amortization of that asset will be adjusted in the future periods to considering the changes in the carrying amount and residual value of that asset. Reversal of impairment loss. Sometimes it may happen that there was impairment loss which was recognized to the asset due to poor performance of that asset, but sometimes the situations may change and the asset may be performing well. So it arises a need to reverse the impairment loss which was previously recognized. So impairment amount for the reversal of impairment loss will be calculated by finding the difference between the carrying amount of an asset, assuming there was no impairment. Here we calculate the carrying amount of an asset up to this period by assuming that there was no impairment loss which was recognized by that time. And also you're going to compare the current amount of an asset for which the impairment loss was recognized. So the difference will be the amount of impairment reversal, which will be recognized in the financial statements. And the aim of doing this is to ensure that the amount of a reversal for the impairment loss does not exceed the impairment loss which was previously recognized. Okay, now this is the second part of impairment, which is about the cash generating unit. So previously we were discussing on the impairment of an asset as an individual asset, but right now we are dealing with the cash generating unit. And as previously discussed, the cash generating unit is a group of assets for which its cash flow depends on a group as a whole. An individual asset cannot generate cash flows on its own. So it can be this is a group of assets for which the operations or the whole group of the assets is the one which results in cash inflows. And sometimes it may happen that this cash generating unit has faced some conditions for which it may need to be impaired. So if any indications exist that the cash generating unit has impaired, we are going to conduct the impairment test, just like we did for the individual asset. So we're going to compare the carrying amount of the cash generating unit against its recoverable amount. Okay, how do we calculate the impairment loss on a cash generating unit? First, we're going to assume the cash generating unit is one asset. So we're going to treat it just like we did in the individual asset. Second, we are going to compare the carrying amount of a cash generating unit with its recoverable amount. And third, we are going to estimate the amount for impairment loss by comparing the carrying amount and the recoverable amount. So if it happens that the recoverable amount of an asset is less than its carrying amount, then you're going to recognize the impairment loss. And the impairment loss of a cash generating unit will be allocated. For example, you have a cash generating unit with 5 assets. So how are we going to allocate this impairment loss? First, we are going to deduct the impairment loss first to the asset which was destroyed. There is evidence that this asset within this cash generating unit was destroyed. So the first step, you're going to allocate the impairment loss to that asset which was destroyed. And if there's still balance for the impairment loss, we're going to allocate it to the goodwill. Second, we're going to allocate it to the goodwill. So the first one was to the asset which was destroyed, and second to the goodwill. And if there is a remainder for the impairment loss, this we're going to allocate it to all of the remaining assets on a pro rata basis. So here is the recap of what we have discussed from the beginning of this review. So impairment occurs when the carrying amount of an asset in the financial statement exceeds its recoverable amount. And an entity should assess at each reporting date whether there are any indications for the impairment. And if there are any indications that the asset might have been impaired, an entity is supposed to carry an impairment test to establish the recoverable amount of an asset as of that date. And if it happens that the recoverable amount is less than the carrying amount of an asset, then that means the entity should recognize the impairment loss for that asset. So amount of impairment loss will straight be taken to the profit or loss account. And for the case of previously valued assets, meaning that the asset which was being carried through the revaluation model and it was previously valued and there was revaluation gain, then the amount of impairment loss should first go to deduct the revaluation gain which was recognized for that particular asset, and if there is any balance for the impairment loss, should be taken to the profit or loss account. And for the case of intangible assets which are not yet available for use, and for the intangible assets with indefinite useful life, and for the goodwill acquired in the business combination, an entity is supposed to conduct an impairment test annually. So, and also on the case of cash generating units, the entity will have to In calculating the impairment loss of a cash generating unit, an entity will assume a cash generating unit is an individual asset, and therefore the entity will establish its recoverable amount and assess whether there is impairment loss. However, on the point of allocating the impairment loss, first you're going to base with the assets, with the asset within the cash generating unit, which is obviously destroyed, and second, the loss will be allocated to the goodwill acquired in the business combination, and if there is any balance for impairment loss, then this will be allocated to the remaining assets in the cash generating unit on a periodic basis. Okay, thank you for being with me up to the end of this review. Don't forget to like and subscribe to the channel, and get ready for the next review. Thank you.